Ladies and gentlemen, welcome back to the channel. I'm your host, and today we're diving deep into the ongoing economic saga that's captivating the headlines, the never-ending inflation game and the Federal Reserve's mind-twisting rate maneuvers. It's been a wild ride, and the Fed seems stuck in a labyrinth where every step forward takes them 2 steps back. But that's okay, right? Because as long as they keep saying, we're in control, we should feel plenty secure. Or should we? So, what's the latest from the Fed's castle on the hill? Tom Barkin, the president of the Federal Reserve Bank of Richmond, has once again ventured out to deliver his prophecy. And it's a familiar tune, he's keeping his hawkish talons wrapped tightly around the economy for a little longer. He's out here in Maryland telling reporters that the risk of inflation surging again is greater than the risk of it collapsing entirely. In layman's terms, Barkin's saying, hey, we've cooled inflation, but don't get too comfortable, and he prefers to keep those interest rates high and mighty to prevent a resurgence in price pressures. Now, I don't know about you, but the phrase, there are still upside risks to inflation, sounds like the Fed's way of telling us, we still don't really know what's coming next. And this is where we should really scratch our heads about the Fed's policymaking logic. Despite 3 consecutive quarter-point cuts recently, which has brought the federal funds rate down to a range of 4.25% to 4.5%, a nice little dip from around 5.25%, Barkin's stance is pretty clear, we're not out of the woods yet. So, they plan to remain, as they love to say it, data-driven, which likely means any future dovish shift will be cautious, hesitant, and perhaps too late to avoid the next cliff edge. Let's be straightforward here, Barkin's signaling something beyond inflation optics. The truth is that the entire economy is under a serious strain, one with roots stretching far wider than simply keeping inflation under control. We're going to unpack exactly why this uncertainty exists, how it reflects serious underlying problems both at home and globally, and how policymaking failures over the years have landed us exactly where we didn't want to be, in a spot where the risks of recession are rising while costs of living remain sky-high. For ordinary folks, these moves feel like déjà vu. Why? Because although inflation managed to retreat slightly, life on the ground doesn't reflect these statistical victories. The Fed's target rate lies at 2%, and while it has made slight progress recently, the December reading showed inflation still at 2.4% compared to last year. After nearly 4 consecutive years of above-target inflation, people are already numb to official reassurances. We've heard similar lines before, inflation will peak and retreat by some magical date, all while consumers struggle with skyrocketing grocery prices, rising rents, and healthcare costs that could bankrupt an ordinary family overnight. The Fed claims victory because headline inflation has dropped, conveniently ignoring that real wages for many have barely budged, or worse, have been eroded by higher-than-wage increases in core costs like housing and services. Let's frame this clearly, inflation might, technically, cool down, but it doesn't mean the pressures on everyday folks suddenly vanish. And what happens when people accept heavier financial burdens as the new normal? Stagnation, that dreaded word no policymaker likes to talk about, the quiet economic trap of rising prices and slow wage growth that grips households for generations. But it gets even worse because, while inflation cools temporarily, there are plenty of reasons, and I mean plenty, that upward price pressures could easily wreck Barkin's, and anyone's, progress. Barkin himself admits that several elements could send inflation hurtling back upwards. Let's outline the key culprits: supply-side shocks, labor costs, and geopolitical turbulence. 1. Tariffs and geopolitical tensions. First off, remember when tariffs were all the rage under the Trump administration? Well, folks, with the upcoming presidency, and continual chatter about reimposing tariffs on strategic imports, the stage is set for even more supply chain disruptions that directly impact prices. Every time businesses face a higher cost to import goods, guess who's footing the bill? That's right, you and me. And inflation doesn't care about targets when it comes to geopolitics. Just one tariff breakdown or political disruption could make today's inflation woes seem like the good old days. 2. Labor costs and wage pressures. In case you've forgotten, wages haven't been keeping up with inflation over the last few years, but wage growth hasn't been stagnant for everyone. Many industries, especially those with labor shortages, have had to boost pay significantly to retain workers. What happens when businesses have to pay more for labor? Right, they pass it on to consumers in the form of higher prices. And the situation Barkin is warning us about, if businesses feel emboldened to continue raising prices to cover their costs, it will spark a new inflationary cycle. Wage price spirals, anyone? 3. Higher productivity or a mirage. Barkin is optimistic about higher labor productivity keeping inflation under control. Now, here's the rub, many argue that productivity gains over the last few months were more about survival, not sustainability. Companies, squeezed by inflation and hiring crises, have automated more processes, pushed workers to the brink, and adopted new technologies in desperation. If this artificial spike tapers off, we'll be back to square one. When the Fed speaks about managing inflation, we tend to forget that real life is interwoven with complex dynamics that the central bank can't fully control. Look at the U.S. economy. The latest job report from November showed 227,000 new jobs and an unemployment rate nudging up to 4.2%. On the surface, more hiring may seem like a strong signal. But ask any professional economist, and they will point to the inherent fragility here. Why? Job creation without matching productivity growth often signals inefficiency or, worse, impending weakness. With unemployment creeping up and still too many questions around labor force participation, remember pandemic-era early retirements and disappearing skilled workers, the Fed is essentially balancing two featherweights on a seesaw, inflation and growth, where any wrong move risks sending one soaring while the other crashes. And hold on a second, what about worker security? Layoffs haven't surged, yet Tom Barkin comments on a more moderate pace of hiring. That's code for companies on edge, not necessarily economic strength. In fact, fewer layoffs might indicate that businesses simply stopped hiring altogether, using the workers they already have to weather the storm instead of expanding. Stalling labor markets could easily mean stalling economic growth. Now here's the cornerstone of criticism: is this minefield the Fed is navigating one of their own creation? Well, remember that monetary policy has ripple effects. Between 2010 and 2020, cheap money, read, ridiculously low interest rates, led to all kinds of economic distortions, from overinflation of asset prices to businesses leaning too hard on cheap credit. The result? A mirage of recovery while critical structural problems, like slowing productivity growth, long-term wage stagnation, and massive corporate debt, were tossed under the rug. Fast forward to today, and rate hikes are coming without a corresponding plan to deal with these very real cracks in the foundation. Barkin, Powell, and company are throwing darts, hoping inflation retreats just enough without tanking the labor market, but you can't have sustainable long-term growth without addressing the fundamentals. Where's the conversation about education? Where's the plan for automation and the next wave of job losses? What about debt management? In summary, what we're dealing with here isn't just a temporary blip in inflation or a rate cut here and there. The longer-term issues at play stretch far beyond the Fed's myopic fixation on inflation. A stagnating economy, geopolitical nightmares on the horizon, no real fix for prices. This isn't good news, folks. No wonder Barkin's forecasting upside risks to growth and upside risks to inflation. We're flying blind in the fog. The bottom line, Barkin's signals show that the central bank is terrified of losing its grip on inflation once again, but in trying to manage it, they risk crushing the economy's fragile progress, creating long-term stagnation, and leaving the rest of us wondering. When are we finally going to see not just recovery, but real, stable, growth-oriented progress? Besides, if you think you're feeling the pinch now, just wait until the tariffs hit, wage pressures mount, and the Fed is left wondering why their playbook failed once again. At this point, the Fed's game of economic whack-a-mole has left us consumers caught in the middle. Is there a light at the end of the tunnel, or are we going to see another cycle of these mishandled policies keeping the economy trapped in a cage tighter than two ferrets fighting over a dollar bill? Until next time, stay sharp folks, there's plenty more to unravel.